My viewers hate short selling and probably short sellers. They also hate the super funds who lend their shares to short sellers. But is this a more rational explanation, or is there a more rational for short selling? The very rational Paul Rickard of the Switzer Super Report dares to be objective about short selling, and he joins me at the desk. How are you, mate?
Well, thanks, Peter.
Now, I'm glad you were prepared to have the guts to do this. This actually came from an email from one of our viewers. I think we've got it here. Here it is. Greg asks, I'm interested in the merits of short selling. In my opinion, it's a form of gambling. What are the benefits it provides, and why is it allowed, particularly when you have hedge funds taking down a particular company or industry so they can make a profit? Okay, Paul, you're the man who has to explain the pros and cons of it.
Well, let's talk about why it's allowed. I think that's a good place to start. It's a great question, Peter, for that very reason.
A lot of people think it.
Yeah, a lot of people don't like it. So let's go through why it's allowed.
Yeah.
I mean, look, I think short selling serves three purposes. First of all, there are people making markets in things like options and other types of so-called derivative instruments, and they need to be able to hedge. So, for example, if you went, and retail investors can invest in exchange-traded options, and they might, for example, want to buy a put option. Someone makes a price, and if it gets set, in other words, the person who sells the option wants to hedge, needs to physically sell some stock to create a hedge. So that's the first reason. Okay. The second reason, Peter, you have professionals taking like a sort of a spread trade. For example, they might want to sort of think that Wesfarmers is going to outperform Woolworths because of what's happening in the grocery business. Yeah. So they might be long Wesfarmers shares and go short Woolworths shares. That's a sort of like a spread trade. Or they might favour Westpac over the ANZ. So you go long Westpac. And
so you think that's reasonable if someone wants to go long one and short another? Yeah, because, and that's why short selling is permitted? That's
one of the reasons. And what that's taking out is sort of the overall market risk. By being long one, being long Westpac and being short the ANZ, for example, you take away all the market risk out of the equation and really just looking at sort of, individual company performance. Is Westpac as a bank going to do better than ANZ? I'd argue that that's not an unreasonable trade to be able to do, and at some stage they'll look to reverse that, and then when they reverse that, they'll reverse their short position. Okay. Then you have sort of the third sort of thing, I think, where the gentleman's question is coming from.
More hated.
Yeah, and where people, and these are only professionals who do this, who take a view that this company is overpriced, in particular, or the market is too strong, and just go short the stock. And usually they look for companies that are pretty weak. In other words, they've got weak management or weak profit records or a history of disappointing the market, and they can sit on these positions for months. We've got some, I think, a chart up there, Peter, that if we can get, which shows you at the moment the companies with the largest short positions. Yeah. If that comes up on the screen.
Monadelphous.
And this is a percentage of their ordinary shares that are short sold. So Monadelphous has almost 20% of their shares.
They are a lot of haters out there, don't they?
Subject to short position. Yeah, Metcash and Myer, I mean, we've seen them sort of the retailers up there for a long time. Primary Healthcare, has been a company that until recently has been doing it very tough, but the shorts have gone back into it. Welly Parsons has been suffering in the resources industry. It's disappointed the market. It's had a number of profit downgrades. Flight Centre is...
Which still well today, by the way.
Yeah, Flight Centre is probably the odd one out there. I mean, I think the short sellers might be doing it tough against Flight Centre. Orica's been a bit of a disappointing company. And then they're the top seven, and so coming in at 13th position is Woolworths, with almost 10%, or around about $3 billion worth of its shares are subject to a short sale. Yeah. That's a lot. Yeah. And that's a lot of money, sort of taking a position that Woolworths is going to struggle.
Yeah, generally, unless you have an outsider view, do you look at that list and the long list and say, I'm going to avoid a company that's on this list? I remember Harvey Norman was on this list, and Jerry took great delight when he outperformed about 2 years ago. And all those short sellers scurry to get back in, and his share price really spikes. So they do get it wrong. But do you use this as a bit of a guide of if you're going to go for a company?
Yeah, look, I don't rule out not in buying a company just because it's sort of in the list of top companies that have got shares sold. But it's certainly input you've got to take, and you're mad if you don't. I mean, it's just nice to know what other people think. Yeah. And for example, Flight Centre's in one of my portfolios, but I can see that there are professionals out there betting that Flight Centre is not going to do well, and that's a very important piece of input. Now, the short sellers don't always get it right. I mean, you mentioned Harvey Norman. They've been short JB Hi-Fi for a long time, and they've got that spectacularly wrong. But look, they get it right more often than they get it wrong. Otherwise, they wouldn't be in business. And I think you've got to look at that data.
Okay.
And it's worthwhile just thinking about.
Well, let's address the gambling aspect and also the involvement of our super funds. Like, you know, why do the super funds make it easy for short sellers to sell down stocks that they're probably holding in their portfolio?
Yeah, look, and for the super funds, it's just a way that they think they can gross up their return, and that is the return they're ultimately going to give to their members. Yeah. As for example,
they lose on, say, ANZ, but they gain because they sell.
Well, I mean, let me give you the contra argument, Peter, because look, these big super funds are always holding, and particularly the major stock, are going to hold some BHP or some ANZ or some Westpac. It's so hard for them not to have one of those major companies and to have none of it, because, you know, the Australian market is very concentrated. So some of the big super funds, they lend out their stock, and the reason they lend out their stock, Peter, is that they get paid for it. So what the short seller does, when the short seller, for example, borrows Woolworths from one of the big super funds, the short seller has to put up cash as security for the loan. Yeah. And effectively, that cash that the fund manager gets when, you know, he or she exchanges the stock for cash, they're able to reinvest that at a higher rate. Even if it goes back into cash, they pick up a little interest rate spread. Now, they'd argue that they're actually doing, by facilitating the short sales, they're actually leading to producing a better return for their members. And remember, what's short sold has to be bought back at some stage. So, you know, at a high level, the argument is that, you know, and there's a lot of people who argue about efficient markets. I think that you can read textbooks after textbooks about efficient markets. That because short selling is just the opposite of buying something, it actually leads to a more efficient market. That is, you know, it puts pressure on the way down. It allows stock to be sold when markets need to fall, and they've got to cover it. They've got to provide demand for stock at some level. There are buyers at a level.
Let me run an argument that normal people would be thinking. Why don't the short sellers actually buy the stock and then dump it to have the same effect? Because that means that you have to put more skin in the game to do it, don't they?
Well, they'd still have to, they'd obviously suffer a risk if they bought at the wrong price, right? I mean, so look, because you know, this is one of the reasons why markets do rebound very quickly. In bear markets is because, you know, you do see the short sellers covering. They provide a natural you know, demand for someone has to buy the stock back. And that's why markets don't go from, you know, $100 to $0. You know, they go to, you know, stocks go, you know, $100 to $10 and then come back again, and it's partly because short sellers are in there.
Do you think,
I think there's good reason for it. I think what we have in Australia is these sort of percentages I showed are probably too high. And that really shows you the thinness of our markets, that people can take that sort of position in the stock. And there aren't others out there who
Do you think it becomes self-fulfilling, Paul, if the short sellers gang up on a company, that company then actually suffers more than it should have?
I think it can prolong a bout of market nervousness, market being out of favour, because some of these stocks, it's really hard to for them to go up in price. Any rally is just sold by the short sellers. And so I think it does take a while for companies that are in their sights big time to really re-establish market support. I think it's just too much. And we have seen an increase in short selling. So I think one of the answers, partly, Peter, is better reporting. The market needs to be informed. Look, the figures I'm quoting you today, you can go to the ASIC website and find them out. They're there, but they're a couple of days old. And I think ASIC needs to get on top of this and make this information available more readily. On
the subject of ASIC, we saw a couple of weeks ago a UK economist really bagged our banks and talked about a house price collapse. And
they like doing that, don't they?
That's right. But he also did it in the company of a hedge fund manager who apparently was shorting the banks. Do you think ASIC should get involved in that? Because I know I was talking to David Murray, and David said, well, it kind of seems like they were kind of leading the market in many ways. Do you think ASIC should be inquiring into that?
Well, I think probably there's a lot going on with it in terms of there is an offence about market rumours and market tipping, and it's in the corporations law. And then maybe there's a little bit of, you know, well, you know, the way that a lot of the media got involved in publicising the story.
Yeah.
You know, I think it was originally current affair, and then it was picked up by a lot of TV.
Herald
and everyone was saying how the bank's lending standard is really slack. At the same time, bank share prices are under pressure. Yeah. It was a pretty well manipulated campaign. And then we had the story, we had the story about bank spreads blowing out.
The film Big Short was doing well.
The film Big Short was doing well. I think there's a case for ASIC to look at that. Yeah. I mean, I think one of the challenges with ASIC is that, and this is why it still gets a lot of criticism, it always seems to be reactive. It's always an after-the-event type regulator and not being on top of this. It's clearly, you know, that our markets are small. We have a small, you know, financial press. Clearly, where does, you know, a lot of the journalists get their stories from? They get fed a rumour by someone, and there's not enough sort of, you know, people forget that is a market offence.
So you and like me are very happy about the rebound in the banks because they were unnecessarily beaten up, and a bit of reality starting to come back to the bank share price.
Yeah, I mean, it sure has. I mean, they were cheap. I mean, and I think we've seen that. And they've led the market back up from, you know, 4,800 odd.
Yeah, and Paul Rickard actually argued it in the Switzer Secret Report, which I was very happy that he got that one right. Okay, that's Paul Rickard.